Thank you all once again for joining me. My name is Christie. I'm one of the senior RMs with Retirement Solution Group. And if you are dialed into this call today, that means you are either already working with us within a 401k plan as a participant, or perhaps as a plan sponsor or a business partner. So we thank you for that. Joining me today is Megan on my team. She'll be helping out with the logistics of the meeting, and she'll be helping me with the slides, which you should be seeing right now on your screen. So today we're going to be talking about how to manage your income and distribution needs after retirement. So, you know, presumably many of us have spent a lot of time, many years perhaps, some of us have been focusing on the accumulation part of retirement, you know, doing everything that we need to do in order to save as much as we can every year, so that when we get to the point of retirement, we have as much money saved up to, you know, last possibly a third of our lives in retirement. So you may not have had the exposure to this type of information in the past. And the next 35 minutes, hopefully, will give you a high level, entrance into these types of discussions and really get some ideas into your head about certain strategies and concepts to think about as you're transitioning from being a saver or an accumulator to a retiree or a distributor. So we'll talk about that. We'll also talk about some other questions. This is just a very loose agenda here that I'll follow today's webinar. So, you know, can I take out as much as I want to every year? That's a very fair question that I get. You know, what if I want to go on 3 vacations one year? Can I take out as much as I need that year? But the following year, you know, much less, because I only have 1 trip. So, you know, how much can you take out each year? Another thing to think about is, you know, longevity. And this is something that we talk about during our meetings annually with participants, is that, you know, due to the fact that we're all living longer, much longer than our ancestors, you know, we have many more years to fund our own retirement. So the concern about running out of money later in life is a valid one. So, you know, if you live to 100, what are your chances that your savings will run out? And then finally, I'll wrap up with a discussion about taxes in retirement, because taxes, unfortunately, is going to be something that you'll have to pay. Most of us have accumulated pre-tax dollars in our 401k and our IRAs. So that's something that we'll need to factor in as we take distributions in retirement, and in terms of, you know, our tax liability every year, what the best way to control that is. So we'll move on now to the next slide. You know, really getting from, you know, the mindset of being a saver to a spender. I've had so many talks with my participants, and this is sometimes a difficult switch to flip, because it's something that you've saved for decades. And we've had it hammered into our heads that, you know, we need to just save. And pulling that switch where suddenly you're no longer saving and now you're starting to take money out of that bucket can be a hard transition. But, you know, my advice is that it's never too early to start thinking about this process, even if you're in your 30s and 40s, to go through this calculation and to figure out the numbers, you know, and just to reduce the possibility of any surprises with the numbers as you get closer to retirement age. That's going to very much help you transition from being a saver to a spender. So here's basically the 3 steps. Very simple, because for those of you who know me, I like to keep things simple. These are the 3 steps that you should start with. So number 1, calculate how much monthly income you're going to need in retirement. That's not going to be an exact number. Obviously, things will change, especially if you are in your 30s and 40s. All you can do is, you know, extrapolate the information. Figure out basically if you're still going to have large expenses like a mortgage payment, or car payments? Will you still be paying for kids' college? So, you know, big ticket expenses like that. And also to really focus on the part of your budget that is, you know, essential. So if you've gone through the budgeting workshop with me in our meetings, you know, your monthly budget consists of about 50% of your monthly paycheck going to the essentials. So certainly do the calculation, figure out what the essentials are going to cost you every month, okay? And then figure out, you know, how much extra money you would like to have during the month for eating out, for entertainment, for shopping, things like that, okay? So figure out monthly how much you're going to need. Step number 2, you're going to add up all of your monthly sources of income, all right? So these are your non-fluctuating guaranteed payments like Social Security, okay? What's your monthly benefit check going to look like? And I'm going to take this chance to remind you all that if you have not gone on the Social Security website yet, which is ssa.gov, that you should put that on your homework list and certainly create your web credentials, pull your benefit statement off annually as part of your best practices so that you can track what your monthly and annual benefit is calculated to be, okay? And then every year going forward, you can tweak those numbers as the calculations refresh every year. So what's your monthly Social Security benefit going to be? Any pension payments that you might be receiving. I know pensions are kind of, going away by the wayside, disappearing. So this may not pertain to you, but any type of regular, you know, income like Social Security or rental income that you can count on, add all of that up for the year and figure out what that's going to provide you on a monthly basis, okay? Once you've done that, then you go on to step number 3. Is there a shortage between those two numbers? And how much is the shortage? Whatever that shortage is that you need to make up, you're going to be using your retirement savings, your 401ks, your IRAs, your investments to bridge that gap. So just a very simple, example here. Let's say you add up all of your expenses and you figure you need $60,000 a year in income. So divide that by 12, that gives you a need of $5,000 a month. So that's what you need. Step number 2, if you've gone through all of your income sources and that gives you $3,000 a month in income, so your shortfall is going to be $2,000. So you need to now factor in $2,000 a month from your retirement savings, or $24,000 a year, to bridge that shortage. So that's a very simple calculation that you can do just in a few minutes and figure out, are you close to your target? Are you very, very far from your target? And then start working forward from there. Okay, next slide. Once you've done those calculations and you start to think about, how much can I actually take out based on my balance? Okay, I know what my shortfall roughly is going to be. Now, based on my savings, how much is that going to provide for me? What are my options? So many of you may have heard about the 4% rule. This is a pretty common and traditional distribution method. It is very commonly used, and the reason for that is because the biggest benefit that it provides is that this method gives you the highest chance of not running out of money, in your 80s and 90s. So the likelihood that your money will last as long as you do is very, very high. However, this is an inflexible method of distribution, and what you do is you take the total of all of your retirement accounts. So if you have, a couple of 401ks and a couple of IRAs, you add all of that up together. And then you're going to figure out what 4% of that balance is. And you're going to take that out in year 1 of retirement. Each year after that, year 2 and onwards, you're going to take that same amount out, but add in cost of living adjustments, so inflation rates. So say it's 3%. So you're going to take out the 4% year 1. Year 2, you're going to take out that same amount plus 3% inflation to factor for that. And, you know, this is assuming that your retirement monies remain invested in a portfolio, roughly 50-50 stocks and bonds, all throughout retirement. So we're still aiming to have your portfolio grow during the time where you've stopped working in order to keep pace with this distribution rate. So let's go to the next slide and I'll give you an example of how this works. So again, the 4% rule, here's the calculation. So let's say you retire and the sum of all of your account balances, all your IRAs and 401ks total $300,000, okay? So year 1, you're now retired and you're using the 4% rule. So 4% of your $300,000 gives you an annual income of $12,000 or $1,000 a month. So that's going to be year 1, you get the $12,000. Now year 2, you're going to take that same $12,000, but add in a 3% rate of inflation, which is $360. So year 2, you're going to distribute $12,360, okay, from your retirement accounts. Similar in year 3. So you're just going to keep calculating what the new distribution amount is going to be based on the previous year's withdrawal rate. So again, this is a very traditional method of withdrawing money. It's not flexible. The benefit, you know, again, of this is that actuarially or mathematically, this method has the highest chance that you will not run out of money, you know, later in life. So for those folks who have maybe a goal of passing along in their estate or in their will, you know, a large amount of money or, you know, a percentage of their account balance onto their children or their heirs, or maybe, you know, a nonprofit, this would be a good method for you to use to try to retain as much of your account balance after death as possible. Okay, so next slide. Looking at the 4% rate of withdrawal, you know, you might ask yourself, well, you know, what's really the big difference between 4% and 5% and 6%? Isn't that just, you know, a very small amount of difference, and really it's not going to impact my portfolio too much? Well, let's take a look at this graph here, and I want to thank our friends over at Financial Fitness for Life, Kyle Bingham, for sharing this information with us, as well as the next couple of slides. This graph really shows, you know, very well the impact of just, you know, a 1% difference makes. So what you're looking at here are 5 different withdrawal rates, okay? Each are color coded. You can see at the bottom, the orange one at the top is 4%, the yellow one is a 5% rate of withdrawal, the green is 6%, pink is 7%, and gray is 8%. So what you have here are 5 portfolios, each with a balance of $500,000, okay? And you can see over this 20-year time period, which at the bottom is from 1999 through till the end of 2020, the difference in the account balances after 20 years between a 4% rate of withdrawal and a 5% rate of withdrawal, 6, 7, and 8. So with a 4% rate of withdrawal at the top here, you can see that $500,000 balance is retained, you know, intact throughout the 20-year time period. And actually at the end of the 20-year time period, you know, you're up a little bit. You take that 4% up to a 5% rate of withdrawal, and you can see after a 20-year time period, you still have, you know, a decent amount, about 50% of your balance left, but certainly nowhere close to the 4%. When you start getting into the 6, 7, and 8% rates of withdrawal, you're not making it that full 20-year time period. Okay, so again, mathematically, if your concern is that, you're going to be running out of money on the back end, this is an illustration of the difference of what just a 1% or a 2% annual difference in the rate of withdrawal can make in your portfolio. Okay, next slide. Let's talk a little bit about sequence of returns. And this is a risk factor that you need to keep in mind both before and after you retire, but much more so after you retire, because the numbers really tend to change. So what it is it's basically talks about your balance, the money that you have saved up, how it's impacted both by market performance, how the market returns every year, whether it's a good year or a bad year, positive or negative, as well as your distribution patterns, which means how much money you take out in each year of retirement, and how your distribution patterns correlate to market performance. So basically, if you, let's say, retire in 10 years, and in that first year of retirement, you decide you're going to take a very high-end, very expensive trip somewhere, and you take out a large distribution to pay for that. And 8 months after you retired, the markets start to drop, So those two factors together are going to create a sequence of returns that will damage your ability to rebound or to make up for those losses, because basically you're now working off of a smaller account value. Okay, you're not going to also have the recovery time as a retired person to have your portfolio rebound as you would as a working person with many, many, many years to go before you have to start taking distributions. So it's very important to keep in mind what the markets are doing in each year of retirement, as well as the pattern or the amount that you're distributing from year to year. So we can go on to the next slide. This is an illustration of how the sequence of returns can work using 3 sample portfolios here, and this is before retirement. Okay, so you've got 3 portfolios here, A, B, and C. And this is a person who's still working, meaning before retirement, from age 40 to 65. Each of these portfolios experience different performance and returns throughout those years, but they all get to the same annualized return, which is 7%. They all average the same return after a 25-year time period. They just each take a different path to get there. So portfolio A in the orange, you can see in year 1 and year 2 and year 3, those are 3 very positive years in the market. So, this portfolio is enjoying some good returns the first 3 years. But years 4 and 5, it experiences some negative returns, but that still averages the 7% annualized. Portfolio B is a consistent 7% positive rate of return every year for that period. Now, portfolio C in the yellow experiences negative returns over year 1 and year 2. And then it rebounds over year 3, 4, and 5. Okay, each year in the graph represents 5 years. So because portfolio C experienced negative years on the front end, it had some more catching up to do, which it did rebound over years 3, 4, and 5, and ended up getting the annualized return of 7% anyways. So there's 3 different ways that these portfolios can average the same return before retirement without having, any impact really at age 65. But let's look at the next slide and see what happens after retirement. So again, using these same portfolios and the same returns. The difference now is that you've retired. Okay, so you have that $1 million account balance at retirement. If you're in portfolio C at retirement, where the first 2 years, or the first handful, or 5 here on the bottom, from age 65 to 75, if you experience negative years in the market, negative performance, and you're also taking out large distributions from your account, and you're no longer contributing to these retirement accounts because you've retired, all of those 3 factors compound to create a situation where you don't have the ability to recover the losses early on. So you can see portfolio C here in the yellow, the account is depleted right around age 87, 88. Okay, it's basically zeroed out because of the factors that happened early on after retirement. So very important to keep in mind that what the account experiences after retirement, especially early on, as soon as you retire, is going to be very, very important factor in determining the longevity of your account balance. So let's look at the next slide. We're going to look at some of the actual methods. It really they fall under different names, so you may see this referenced in a different way, but this is really a set dollar amount that you can take out, and this is another way of explaining the 4% rule that we already talked about. So basically, one way to distribute is to take a set dollar amount each year and then add in the inflation annually. So this is a method that does not factor in the market environment, whether you're experiencing good market conditions with very positive returns, or you're in a bad market year where your account balance might be on the lower side or negative returns. So none of that is factored into this method. What is factored in is inflation. So you typically use that 3% rate of inflation, or if things are more like they are now, you might use a higher rate. But year over year, you're going to take out that same dollar amount plus what you need to factor in for cost of living. So the benefit here is that it does provide you a stable income stream, and as long as you've done the calculations for what you need on a monthly budget, it's going to cover what you need to pay for your bills and live the way you want, okay? However, it does not factor in the markets. The next method, on the next slide, is one that has you distribute a set percentage of your portfolio. So within this method, the amount that you take out from your retirement accounts is actually going to fluctuate every year, because what determines the exact dollar amount is the markets. So if you're having a good year in the markets, that set percentage that you've decided on is going to be calculated off of a higher balance. So the income that you're getting from your portfolio might be higher in the years where your market performance is higher. Now, on the flip side, if we're having a down year in the markets where the markets are down 15 or 20% like they have been this year, that same percentage calculated on a lower account balance is going to give you a lower income amount. So you might consider that the income that you need may not be met. So those calculations that you made off of your budget, what you actually need to cover your bills, may not be covered in years where the markets are not performing well. So that is the downside of this method. On the next slide, we have what's called the dynamic spending method, which is become more popular recently because it is much more flexible. And when you have market conditions that are volatile, like we've experienced over the past several years, it's important to use flexibility if you're able, to cover your expenses as a differentiator and be able to take out more in years where the market is performing better, and to take out less when the markets and your account balance is lower. So basically, this is a method where you take a look at where the markets are at every year. You sit down with your advisor and you talk about, what your needs are going to be that year, and you talk about what the expectations are going to be for the market, and then you decide on an annual basis what your distribution rate is going to be. So that is the dynamic spending method. Next slide, please. So keeping all of those methods in mind, and you can go through and really make calculations using all of those methods and figuring out, which one works best for you on an annual basis. You don't have to stick to one method. You can go from one method to another as your situation changes, as the numbers and your needs change. So I think the key is to be, really flexible and to be aware of all your options there. So in terms of the order of withdrawing your money, this is basically a traditional approach to withdrawal order. Okay, so the first thing you're going to take out, again, is any income payments that you're expecting, like Social Security, pensions, rental income. Okay, so once you've done that, okay, you have that dollar amount. The next thing you're going to move to in terms of withdrawing, if there's a shortage, is any money that you have in brokerage accounts that are taxable. Okay, so you're looking at, your Schwab trading accounts or E-Trade, anything like that that is not within a retirement tax deferred vehicle. Okay, so what's the logic behind that? So these are accounts where you're going to be owing taxes on regardless. So the rationale is to distribute from those accounts next, because there is really no benefit to waiting on distributing those funds. The other piece of that, obviously, is short-term gains and long-term capital gains considerations. So that's a whole other discussion. But basically, if you have holdings for under a year and you sell at a gain, then you're subject to a certain capital gains tax rate, which is much higher than if you hold something for over a year, which then you pay, long-term capital gains taxes on the earnings. So if you're able to hold on to something and manipulate that for over a year, that would be advantageous for you paying lower taxes on. But regardless, after you take your Social Security and your benefits and your pensions and all of the set payments, moving on to taking distributions from your taxable accounts would be next. Third after that would be taking distributions from taxable accounts like your 401ks, like your traditional IRAs. And after that, then you would move on to your non-taxable accounts like your Roth 401k and your Roth IRAs last. Okay, so let's dig into this a little bit on the next slide. Homework, getting started with order of withdrawal and, methods for distribution. Again, this is a good place to get started. Certainly digging in with, one of your relationship managers that you're familiar with. I'm happy to help with this discussion. Again, it's never too early to start thinking about these steps and getting these numbers on paper and figuring out what your shortfall is. But, what you should do is really calculate again how much monthly income you're going to need, And then from that point on, trying your best to estimate what your life expectancy is going to be. So that's going to be factoring in your genetics. You know, does everyone in your family live to their late 90s? Or are they, you know, on the shorter side of life expectancy in their 70s? So, you know, that makes a big difference. Adding on 10 or 15 years of income that you're going to need in retirement is a big part of the calculation. And you can use different life expectancies to do these calculations. You can pick a number, you know, somewhere in the middle and just take your best guess at what that's going to be. Or you can err on the side of caution and use a longer one just to make sure. Then you're going to add up all your sources of income and figure out what your potential shortages are. And then from that point on, to cover the shortages, you're going to use your retirement accounts and decide from year to year what the best withdrawal method will be, whether that's going to be 4% rule one year or dynamic spending the next. And as your plans change in retirement, you know, which method you should use from year to year. Okay, so we're going to pivot now to the next slide. Looking at the last part of today's talk, and that is taxes. Okay, we will all, you know, be subject to taxes on the accounts where we've deferred taxes on. So, you know, the 401k traditional contributions, pre-tax, the traditional IRA contributions. So taking a traditional withdrawal approach, basically what you're looking at here is on the top, the first, you know, 7 years, I'd say, in retirement, you know, looking at taking taxable withdrawals. So taking first, of course, your income, and then looking at your brokerage accounts and depleting those first in the first 7 years. And then you get into year 8 through 18 or 19 in the green bar graph. So you can see the distribution amounts kind of increasing in years 8 and 9. And the reason for that is because minimum required distributions start to kick in at age 72. And we'll talk a little bit more about that on the next couple of slides. But, you know, in years 7 to 8, you're going to start being required to take money out. And there's a calculation involved in terms of, you know, your life expectancy. You get a number, multiply that by your account balance. And anyways, you're required to take out a certain amount, a certain minimum, starting at age 72. And that's why you're going to see a bump up in the distributions starting at years 8 and 9 in the green graph. Okay. So once you've depleted the traditional withdrawal accounts, then you move on to the purple, and then you take out from the Roth accounts in years 19, 20, 21, and so on. Now down below, you can also see the taxes that you owe also ramping up in years 8 through 18, because again, you're starting to dip in under this traditional withdrawal approach to the RMDs in those years. So you have to make sure that you're prepared to pay these taxes during the years where the RMDs kick in, and that, you know, your withdrawal approach are gonna, you know, that's gonna cover your tax bill and still cover what your monthly income needs are. And if we look at the next slide, this is a proportional withdrawal approach. So this is different from traditional. And this is another way that you can take money out in your 20 or 25 years of retirement. And using this method, it smooths out your tax bill over each year instead of having that bump up that we just looked at under the traditional approach. So if you decide to withdraw proportionately every year, you can see down below that you're going to be paying pretty much, you know, the same in taxes for 23 straight years because you're taking a proportional amount from each bucket. So this might work out better for you depending on, you know, how much you have in each of these different types of buckets, in the taxable bucket, the non-taxable bucket, and the traditional one. So if you have someone you work with on your taxes who has access to, you know, your full financial picture, it might be worth your while to plug in your numbers using the traditional withdrawal approach as well as the proportional one, and seeing, you know, which one might work better for you. Or if you just simply like the concept of spreading out your taxes evenly every year in retirement versus having a bump up, you know, you might be more drawn to this proportional approach. So those are just some different options for tax efficiencies in retirement. So we'll move on to the next slide. Let's talk very briefly and wrap it up with a discussion on RMDs, or required minimum distributions. So the age at which you're required to take out at least a minimum amount from your retirement accounts used to be 70 and a half, now it's 72, and possibly could go up to 73 or 74 with the new Secure Act provisions that's now being discussed. So as of right now, if you turn age 72 and you have not taken distributions from your 401ks or IRAs, you will be required to take out a minimum amount, unless you're still working, in which case you can delay that on the 401k side, okay? So all retirement accounts have to be factored into this calculation. All 401k accounts and traditional IRAs must be factored in, okay? Regular income taxes apply to the distribution. And if you miss the deadline, which is 12/31 of the year that you turn 72, you're going to be paying a pretty hefty penalty, and that's going to be 50% of the amount that you should have distributed that year. So luckily, you know, there's a lot of help, you know, with RMDs. If you work with us, you know, certainly the calculation and the reminders come from our office. If you are with a record keeper or an IRA custodian, most of the big ones do send out reminders and will do the calculations and help you take the distributions out. So there's a lot of help out there for you to take the distribution, to take the correct distribution. You are permitted to take out your RMD amount just from one account if you have multiple accounts. So let's say you have 3 IRAs and you calculate your RMD to be a certain amount. You can take out that amount from just, you know, one IRA. You don't have to take out 3 separate distributions, as long as you keep it within the same type of vehicle or same account. So you can't, however, calculate your RMD under all of your IRAs and take it out of your 401ks, because those are 2 different investment vehicles. So, and then the last thing I wanted to mention with that is the RMDs do apply to your Roth 401ks as well. So this has been a common, you know, mistaken fact. You know, you're not taxed on the Roth 401k distribution because you've already paid taxes on it, but you are still subject to distributing the RMD on the Roth 401k because it's within the 401k account type. So in terms of figuring out, you know, how much you need to distribute, it's pretty simple. You're going to Google uniform lifetime tables, and you're going to find your age. Next to your age, you're going to have basically what they call like a divisor. It's a number that you take and divide into the balance of your retirement accounts that are subject to the RMDs, which is going to give you the distribution amount that you need to take out. So it's a pretty simple calculation that you could do on your own, but certainly take the help from your custodians and your financial advisors, and they'll give you an exact dollar amount to distribute. So that's what happens at age 72 with RMDs, and certainly a large part of, you know, your planning for income distribution in retirement. Okay, so I think that wraps up the content. We're going to go on to the next slide just to make sure. Key takeaways here, as always, you know, RSG's message is to prepare early. You know, my favorite type of participant is that 20-year-old who's just started their first job and is, you know, asking me questions about what happens after retirement. You know, you can never prepare too early because you're going to have to make adjustments along the way. You're going to have to change your plans and pivot, and in certain years you're not going to be able to save as much as you want, and in other years you might be able to max out. So the key is to be flexible and to plan for longevity. So just make the assumption, maybe err on the side of caution, especially if you're on the conservative side, that you will live into your 80s and 90s. But at the same time, not to put yourself on so tight of a budget that you're shortchanging yourself in retirement. So doing the math and the calculations that I just talked about today will certainly help you clarify maybe, you know, which method you're leaning more towards. And of course, arming yourself with knowledge, the fact that you're logged in today learning about, you know, this piece of the retirement planning is huge and puts you ahead of a lot of other participants. It gives you, you know, the best possible strategy for making decisions for your future. So my contact information is on the final slide here. The office phone number there, and my extension and my email. So I'd love to hear from you. Any questions? Love to set up any one-on-one times to go through your particular personal questions, account reviews, or feel free to reach out to your assigned relationship managers, Megan, Chris, Steve, Scott, Elvia. You know, they're all happy to help you, you know, in each stage of your planning. And I want to thank you again for your time today in logging in. Again, a recording will be available within about 48 hours. That'll be sent over to your plan sponsors if you'd like to review any of this information. So let me really quick see if there are any questions in the chat box here. All right, we look like we're good. So I'm going to end today. Again, thank you all so much for attending today, and I hope to hear from you soon. Have a great day.